Hey everyone, welcome in to another daily editorial here on the KE Report, chatting with Craig Hemke. And instead of looking back like we have in the last couple interviews, we're going to look ahead to this week because it is another heavy week of a Fed meeting and inflation data. It's been almost thought of as one of the last more data heavier, more important weeks for the markets, for investors as we head into summer. A lot of eyes are going to be on the Fed meeting because of the fact, well, it's the one that's coming where people did say, hey, maybe we will get a rate cut in June. That seems to now be pushed off. But just last week, we did get a couple rate cuts out of the ECB and the Bank of Canada. Plus, this Fed meeting, it's a quarterly meeting, so that means we do get the dot plot. A lot of eyes are always on the dot plot. Craig, what are your thoughts? What should we be looking out for when it comes to the Fed meeting and the statement and press conference coming on Wednesday?
Well, hi, guys. Yeah, it's going to be a very volatile week. There's not much scheduled news, at least, here on Monday and Tuesday. So there'll be a lot of kind of sideways choppiness as the week begins. Most folks have been following along what the price of particularly silver has been doing in Shanghai. And Shanghai was closed on Monday. Usually when trading opens, it's about 9 o'clock Eastern time in the evening is the morning in Shanghai, and that's when their trading opens. Well, we didn't have that Sunday night into Monday. And so China has not traded since Friday, early Friday morning. I'm not sure I think the announcement that hit the wires about the People's Bank of China not buying gold last month actually hit after Shanghai closed. So we'll all kind of wait anxiously to see what they do here Monday night, Tuesday morning. That'll be the first thing that we'll watch this week. Now, last week, there was a big hit on the precious metals on Tuesday, and on Wednesday morning in Shanghai, they fall along and fell 3.5% or something like that, but then turned right around on Thursday and went right back to where they were on Tuesday. And that's all part of why silver and all the other commodities rallied then on Thursday before then. Of course, we all know what happened Friday. So the first thing we'll watch this week is what happens in Shanghai. Probably lower, I guess we'll say tonight, but Tuesday morning, but then maybe right back up. We'll see what they do Tuesday night, Wednesday morning. And then Wednesday morning brings the next CPI report, Consumer Price Index here in the U.S. That's obviously going to be watched closely. Later that day, here comes the Fed. We get what I call the Fed lines at 2 o'clock Eastern, and then Powell's press conference. I would imagine what has been well, I don't want to say it consistent. Well, because it's not like this all the time, but the most regular outcome on a Fed day over the last year or so has been a move downward when the Fed lines get released, and then a bottom about the time Powell starts speaking a half hour later. And I suspect that'll be the case this week, too. The Fed lines might seem kind of hawkish in that dot plot you mentioned, Corey. But once Powell starts speaking and he starts getting asked about that report by the FDIC here in the States last week said there were 63 banks on what they call the troubled list. For the fact that even with that 270,000 new part-time jobs or whatever that were added on the BLS report last Friday, the unemployment rate ticked up to 4%. So Powell's comments might end up being construed as bullish. So anyway, then the next day brings the PPI. So there's a lot of stuff crammed into that kind of Tuesday to Thursday time period, and we're certainly going to add to the volatility of last week.
We absolutely are. We always see a few head fakes either direction around the Fed speak, and the day after is also interesting to see how it levels out. But just a question on the QT, the quantitative tightening program the Fed's been on. We were discussing this before the call that they've been ramping it down. I think originally it was that they were getting rid of $90 billion a month off the balance sheet. Then it was 60. Now they're going to be going down to 25. Eventually, they're going to stop that, which also means they could be buying bonds on the other side of that because they're not tightening as much and they may start buying bonds. How does that affect the bond markets and interest rates? And how does that affect the markets?
Well, we'll see how that goes. You could say in some instances that maybe all that Fed selling has added to some of the other central bank selling. I mentioned China earlier. I mean, most people are familiar how the Treasury holdings of the People's Bank of China has been in pretty steady decline for the last 7 or 8 years. So the Fed has just added to that, and that's all part of what has moved longer rates higher. Now they're getting a lot of treasury issuance coming into the short end, which at some point you would think would drive the short, with all this extra supply coming in, would drive the short end even higher. And then all of a sudden you get even a more negatively sloped yield curve if the Fed keeps dumping. So there's just a lot of different considerations that they need to be making when they try to plot their way forward. The interesting thing will be when the time finally comes that they are forced to become the buyer of last resort. I mean, we're not there yet, but with this ever increasing debt and deficit, what are we adding here in the States now? $2 trillion a year in what is supposed to be a strong economy. What happens when inevitably the next recession hits, if it hasn't already, and your tax receipts plummet and you continue to spend like crazy? At some point, just to keep rates in line, the Fed, I have no doubt, is going to attempt some measure of yield curve control where they just say above a certain 4% or 3% or whatever on the 10-year, we are buyers. And that's their chance. And the balance sheet blows back up to the upside. We're not there yet, but I've always had the sense that this QT idea, while serving the idea we're going to help push up long rates a little bit to keep them up with short rates, so we don't get too negatively tilted on the yield curve. I also think they're just clearing the decks. And, if you go all the way back, we've talked about this before, guys. March 1st, Friday, March 1st, was the day gold broke out. It was already about $10 that day when all of a sudden Goon Waller comes out, Fed Goon Waller comes out and says, and basically said that. He said, we are going to have to shift things around so that during the next asset purchase program, we've got some room to do it on our balance sheet. And people went, what? Huh? More QE? Gold shot $30 higher, finished the day like 2090, broke out on the weekly chart and followed on with another $100 the next week. So they've admitted that's kind of the way they're going. They're not going to come out and say we're headed toward yield curve control. But in the end, I don't see much choice. In the meantime, any QT they do, again, to my mind, is just kind of trying to clear up some space for the eventual restart of QE.
Fair enough. But in a way, they kind of had to clean up some of it. And this has actually gone on probably longer than a lot of the naysayers thought that it would. But Craig, as we look forward to with what the Fed could do in terms of getting into the markets, getting into the bond market, are you discounting any major moves with the election coming up and how this year being an election year in a way makes the Fed political no matter what they do?
No doubt about it. We've seen quite a deterioration of the economic data over the last month. If you look at some of what Citigroup and Bloomberg have their economic surprise index, which is kind of a aggregation, compilation, whatever, of all of the data rather than just trying to cherry pick one or two here, which is really hard to do. They're really trending downward. You've seen, I'm sure, the latest from the Atlanta Fed. They got that little fella down there that cranks out what's called GDP Now. A month ago, he was projecting the second quarter at 4.2%. He was supposed to have updated last Thursday, and I just didn't see. But prior to that, he'd already cut it to 1.8. So the economy is slowing. We are, 5 months out from the U.S. election. If the data continues to deteriorate, there is going to start to be a very steady stream of voices on the left, from Pocahontas to Bernie Sanders to you name it, that in the name of left-wing populism, they're going to say, you got to help the man. The middle class is struggling. The Fed is the enemy. They got to start cutting rates. And that pressure will begin to build as well. All part of what makes, I don't want to say fascinating. The back half of the year isn't going to be fascinating. It's not going to be fun either. But it is going to be interesting to see how it all turns out.
Well, Craig, just to take a step back from the U.S. economy and look at the global picture, you brought up China initially in the discussion as far as being out of the market, coming back into the market this week. It'll be interesting to see how that goes. There's been a lot of focus in the metals on the buying from the East, that really things have moved from the West to the East. But there's also been an effect on how people are viewing things like copper, silver in a way, because they've had a real estate mess. They're trying to bail out the real estate mess. How much of that do you think factors into the moves we've seen in silver and copper, which have really gotten hit a lot harder than gold over the last couple of weeks?
Yeah, the copper thing is a weird one. And for people that catch these discussions we have every week. I mean, this is something we've discussed now for about a year and a half. And look, I barely should be considered an analyst of the precious metals. I don't know why anybody would think I know much about copper rather than just observing and reading the headlines. There are people like Robert Friedland that think, wow, the copper market is going to be in supply deficit going forward. The amount of copper needed over the next 5 years versus what's been mined historically is just mind blowing. But then you read things and say, oh, but there's plenty of copper around. There's 500,000 metric tons laying around all these different vaults somewhere. So then you factor in what happened with the price last month. And there were some, and I thought it was a function of a physical supply depletion, but then there was some thought, no, this is just a short squeeze on the COMEX. What we know now, here a couple weeks later, perhaps that is exactly what happened because the CME came in with 4 margin hikes in 7 days and price collapsed. 15%? Would it hit 517, then went down to 450? I do the math. I guess that's pretty close. So we'll see where it goes from here. There's still the old industrial demand part of it, global economy, Dr. Copper. If the global economy is slowing, then copper should be going down. And we've certainly seen that happen, obviously, and crude oil too. But we'll see. I don't know. A lot of the trading of the derivatives is also a function of dollar strength and weakness too. So the copper market continues to confound me. I don't know if I've really given you an answer to your question, Shad. But like I said, I'd probably be more of an observer than I am an analyst.
So what about the dollar then, Craig? There's, I think, a balance between bulls and bears out there for the dollar. The dollar is up on the year as it really entered this year right around that 101 to 102 level. And it's been grinding higher. Hasn't really broken out. It's still off of its highs from the October timeframe of last year. But really, you go back a couple of years, the dollar's been relatively stable, above that $100 level. Now I know it's weighted a lot against the euro, but we have seen issues in a number of other countries. What do you think the dollar's future is? Which currencies are going to drive the other end of that trade?
Well, as you mentioned, Corey, it's an index weighted with all the other fiat. So when we talk about the dollar being stable, it's just stable against all the other fiat. And then you look at gold being up 15%. You can say, well, it's down 15% versus gold. That's one way to look at gold as a foreign currency pair. But here's an interesting thing about last week. We had, as you guys mentioned earlier, the Bank of Canada cut their, I don't even know what you guys call it up there, primary rate or whatever, by 25 basis points. And then the next day, here came the ECB, and they had telegraphed that. There were a couple of ECB goons that said 25 or 50 basis points in June. And so they cut 25. And that news hit on Thursday, and that didn't impact the dollar index at all. You'd have thought with the ECB cutting rates that the euro versus the dollar would have gotten weaker, and with the euro being about 57% weighted in the dollar index, so the dollar index didn't do nothing until the jobs report that was allegedly so strong on Friday came out, and then all of a sudden it shoots up, 70 or 80 cents. So it's really hard to make a case bullish or bearish for the dollar, and it's been kind of trading sideways after what looked like a double top about 60 days ago. And I think the market kind of sees that too. Long term, and maybe this is a good time to make the point again, I see so many people, whether it's on my site, whether it's on Twitter, X, other analysts that look at the dollar versus as a primary reserve currency and look at the whole thing as like kind of this binary thing. That one day the dollar is going to go from having this value and strength to having then no value. But there's going to be a replacement, and the dollar's going to lose reserve currency status and all this. And it's like this A-B thing. And it's not that at all. The dollar losing its primary value is what may be kind of, as a global currency, is what gets kind of eaten away at. It doesn't go away 100%. Dollar's still going to be there and people are still going to use it. It's just that the percentage weighted of the dollar in foreign currency reserves and in global trade will just continue to decline. I mean, it's been rising a little bit lately because, again, there's still no other real alternative to it. But eventually alternatives will appear. And eventually over time, demand for dollars is going to fall at a time when supply for dollars is ever increasing. And Econ 101 just says, look, if any good where demand is falling and the supply is increasing, the price of that good goes down. The same thing will be true for the dollar. So anyway, that's kind of a long and short-term perspective, Corey. And again, it augurs, if you believe that kind of stuff like I do, and then you just hold precious metals. You hold physical gold, physical silver, because as hard assets, they're more apt to retain their value and then benefit from weaker fiat currencies over time.
All right, Craig, we'll wrap it up here. Always fun chatting with you. We'll see what the rest of this week holds. Fed meeting and inflation data going to be very interesting to see what the market reaction is on the back end of that. And then we're into summer. So is it going to be a slow summer, or are we going to see some fireworks over summer? Those are the main questions that I'm sure we'll keep on touching on as we chat with you pretty much on a weekly basis. Craig, thanks as always for your time. Have a great rest of your week.
You bet, man. Take care.